So to start, we will deal with three sections. To begin, we'll talk about corporate bond valuation. So how do we actually figure out where a bond, quote unquote, is? That's important because all of this data is going to underlying the analytics that we deal with in Section 2, which is looking at debt issuance, both looking at where bonds were of your company, assuming that you are the issuer, and similarly rated companies, let's say in the same industry, are trading, so we can determine where, when you come to market, you might issue bonds. And then third, we will look at additional analysis, and that will be slightly more advanced topics along the lines of debt issuance, talking about things like cross-currency and fixed versus floating decisions. So bond valuation. The corporate bond market is, as you all know, is an over-the-counter market. So unlike an equity where you can look on an exchange and say, okay, that's where the bond is or is trading, in corporate bonds, the bond could be one price at Goldman, it could be another price at Deutsche Bank, et cetera. So how do we value bonds? Now, there are different valuation providers out there. At Bloomberg, our method is called BVAL, and that's Bloomberg Valuations. And again, this will underline all the analytics that we do in the second and third section. So what is BVAL? I'm sure many of you have heard of it. A lot of you probably know the inputs into it, but let's just take a moment and take a look at it. There are three main inputs into the BVAL model. So we're going to look at a particular bond. And today, we're going to be, let's look at Home Depot 270s of 23 as a representative bond. There are three main inputs into the BVAL model, and those three main observable inputs. So we're looking at what are the observable data on the bond. The first of the three is trade data. So in the U.S., FINRA regulations require dealers to report the details of the trade within 15 minutes of that trade. You all could look at trades in your bonds or in the bonds of, let's just say, peer issuers by loading the bond on Bloomberg and then going to a screen called QR for quote recap, and it's trade and quote recap. And that's what you're looking at here on the screen. And here's a list of all trades in this Home Depot bond. I've limited it, you see, in the size column to just trades over 249,000. This way I filter out retail trades that may have pricing that are not indicative of where the bond is trading. And then I chose a specific trade just to focus on so you can see what all the numbers and letters mean. So that is a $1.3 million trade on October 15. The next column shows that is a dealer, which is the middle column. That is the reporting party. That's the D. A dealer buy. That's the left-hand letter under RPS, which is reporting party side. And the trade is with a customer, and that's the C. That's the counterparty. So that is a dealer buy from a customer. That's the bid side of the market. The dealer must report the size, all those types of details that we just talked about, and the price. The spread is a calculated number. So the trade must be reported within 15 minutes. So that spread of 15.5 isn't necessarily where the bond was traded, but it is a calculated spread from that price as soon as it's reported in that 15-minute window. So it's going to be pretty close unless the Treasury market is wildly volatile in those 15 minutes. So you all can take a look at the trades. This is feeding into our valuation model. The other inputs into the model, observable data, are executable bids and offers, and those are executable bids and offers coming from the sell side to the buy side on the Bloomberg platform. For example, we've got a function called All Q, where dealers can make markets in bonds to the buy side. And additionally and importantly, a very important way that the sell side trading desks communicate with the buy side is by sending messages and runs over the Bloomberg terminal. We consider those indicative bids and offers, and that would be a dealer quoting this bond, even saying, I want to buy this bond, call me now. But because it's not on an executable platform, we consider it indicative bids and offers. Bloomberg has licenses with many of the major dealers that allow us to ingest this pricing information into our model. And for me, that's really a huge value for the Bloomberg model. So for you, you could load one of your bonds, in this case, HD Go, and run BVAL Go. I'm on the Direct Observations tab. And what this is doing is if you look on the right side, you'll see that Direct Observations account for 100% of the pricing of this bond as of the pricing of this bond. On the left-hand side, you'll see low 415. That's London 415. The BVAL model will mark a number of times a day. For West Coast clients, when you get in, that will be London noon when you get in. Then there'll be a London 3 p.m. spot, a London 4:15 p.m. spot, a New York 3 p.m. spot that will serve as the pricing source for the Bloomberg Barclays indices, and then a New York 4 p.m. spot. And then there are a number of spots overnight in Asia. You can get the bid, mid, and ask side of the model. Here I used mid. And what this is telling you is that there was plenty of information on this bond for the model to just use information on this bond. And that's what direct observations at 100% means. And then below that, you'll see a breakdown of what the model used. This I find to be very valuable. So you see that trades, even though there were a decent number of trades, there weren't a lot of trades. Trades only accounted for less than 1% of the inputs into the pricing of this bond at that time. Executable bids and offers at 22% and 15% respectively come from the Bloomberg trading platforms. And then indicative bids and asks, which are the messages and runs that come from the sell side to the buy side, make up the balance of the pricing of this bond. In the upper left, you'll see that there's a score, and that's a score from 1 to 10. And the more concentrated data that there is on a bond, the closer or at 10 that score will be. There can always be outliers because there are going to be dealers that have sort of throwaway bids or rich offers. The model disregards those and looks for a concentration of data. And in this case, you'll see the price of the bond, 103.016, and then relevant spread metrics, spread to maturity, Z-spread, et cetera. Now, there are going to be bonds such as the El Paso Electric 6s of 35, where there's just not a lot of observable data on the bond. Maybe it doesn't trade that often. Dealers aren't making markets in it on an executable platform. Maybe they are sending messages on it. So what you see here is I've clicked the third tab on this El Paso bond. So observable comps. And what you'll see is that observable comps in the upper right account for 2.1%, meaning observable data accounted for 97.9%. And then the balance is filled in with something else. So what is that something else? It's a model. And in the case of investment grade, it will almost always roll to this observed comps. So what the model will do is look at other El Paso Electric bonds, normalize those to par, meaning if a bond has a high coupon, high dollar price, if it's old, if it's a small issue, it'll adjust that spread tighter to make it more like a par bond, and then it will fit a curve through it. The model will look at similar type issuers. So in this case, it's going to be investment grade utilities to get a sense of the shape of the curve. What is it supposed to look like? 2s, 3s, 5s, 10s, 30s. And does the El Paso Electric bond curve look like that? And then it will reprice the bond with its characteristics, because here you see this is a high dollar older bond off of that curve. All of that will plug into the observable data and give us our price, score, etc. So that's pricing. Really just want you to understand where all this data is coming from when we get to the next section. And this next section is debt issuance and peer analysis. So what we're going to do is we're going to look at a way for you to easily be able to look at, as an issuer, your debt stack, look at your curve, look at similar for peer issuers, and then use that information in deciding whether to come to market or not. You know, where can I borrow in 10 years? And then when you ultimately get into the discussions with your underwriters, who they're always going to have the best information in terms of where the demand is, from what clients, in what currency, what point of the curve, is there value in issuing fixed versus floating, et cetera. But what we're going to do today will give you transparency into where your outstanding debt is, which I think will put you in a better position negotiating when you are actually coming to market. So let's take a look. Here we're going to introduce, some of you may be familiar with this. It's called the Fixed Income Worksheet. And for those who have not seen it, this will be the basis for our analysis, or the main tool that we'll use in our analysis. And what Fixed Income Worksheet is I'm going to take some source of bonds, and that's in the upper left-hand corner here. So here you see LBUSSTAT. That is the AG, the Bloomberg Barclays AG, and the reason it's LB is it was originally the Lehman Brothers U.S. AG. So let's say we start with that source. Now we want to narrow that down, and we're going to narrow it down by that left-hand column, which are the facets. And the facets are just search criteria that allow you to take that source, so the AG, which is all investment grade bonds, and narrow it down by sector, by ticker, by whatever. And we're going to get into that in just a moment. And when you narrow down, it will give you the list of bonds that meet the criteria. And you'll see across the columns, you'll have descriptive and valuation information on each bond. For those of you who are familiar with Bloomberg, two of the most common functions are DES, Go, for the description. That would be things like coupon, maturity, ratings, rank, etc. And YAS, and that's yield and spread analysis. And that's things like price, yield, G-spread, etc., which we'll get to in a moment. And you'll see in the upper right-hand corner that the pricing source here is BVAL, which is what we discussed in the beginning. So if you think about this, this is running a YAS and a DES on every bond that meets your criteria, which is very powerful to have in one place. All of this is searchable and sortable, which we'll get into as well in a moment. So for all of you, it's going to require a little bit of customization to fit it more to a corporate debt issuer. So what we're going to do first is customize the facets. And the facets, we're going to add things that I think are going to be relevant for you when you are narrowing down the source. So what I did was I clicked the pencil, which I'll go back to the screen here. On the left-hand side, the facets menu in the upper right-hand side, you'll see there's a tiny little pencil. If you click that, you'll get a pop-up menu. That looks like this. On the right-hand side of the facets or the search criteria that you have, things like ratings, amount outstanding. B-class is our classification system for sectors. And here I'm showing you that you can add things like calculation type, ultimate parent of the issuer, coupon type, that's fixed versus floating, currency, etc. And then you would just move them over. And you'll see on the right, I've added things like ticker, etc. When I close, my facets menu on the left-hand side is now going to include those things that I added. So here you see currency is there, calc type is there, etc. And let's take an example today, and we'll be Home Depot. So what I'm going to do is I am going to narrow down to retailers, U.S. dollars, and I'm going to do fixed rate bonds. And you'll notice in the upper left-hand side, I've changed the source from that index, from the AG, to all outstanding bonds. And the reason I did that, for investors, a lot of times they're happy just to look at the index. But for you as issuers, you may have a deal that's not index eligible. Let's say it's a $200 million deal. That's still very relevant to you because that's in your debt stack. So, we want you to have the ability to look at that bond as well. And we can show you later how you can filter that out. But what we've done so far is we've been introduced to FIW as a multi-bond calculator tool. We've changed our source from the index, which is going to be the default when you first log into FIW. We've changed it to all outstanding bonds by just clicking in that yellow box in the upper left, all outstanding. We've modified our facets to include some of the things that I think are going to be important to you as issuers, like currencies and tickers, etc. And now we'll move forward. I took the left-hand menu, and you see where it says hide facets in the upper left. I'm just going to hide the facets so we get some more screen space. And I've grouped in the upper left-hand by CAST parent. CAST is our capital structure group. And what we do is we look at all the securities outstanding, and we say, okay, what parent do these ultimately roll up to? You don't have to do it by parent. You could do it by ticker. But I find that parent is usually the easiest way to look at it because sometimes under a corporate parent, there could be many different tickers. In retail here, now we're looking at Costco and Home Depot. And again, remember that we're Home Depot. But what you're easily able to pick out here is the column G-spread. And for those of you who are not familiar, G-spread stands for government spread. It's taking the yield to maturity on each of these bonds, looking at the yield to maturity on the interpolated point of the government curve that matches the maturity. So for let's say the Costco 3s of 27, May 1827, we're taking the yield to maturity on that bond, which is 2.198, which you see right there. We're subtracting out the Treasury curve at the May 2027 point. We do that through an interpolation between the 5 and 10-year points on the curve, and that gives us 50 basis points, so 0.5%. So what is that? When investors are looking at your bonds, they're saying, what am I getting paid for taking the risk of this issuer? So in this case, for Costco in the 227, they're getting paid an extra 0.5%. If I look lower down at Home Depot and I look at the last bond that's on the screen, the 3 3/4 of 24, Home Depot, investor getting 23.9%, 23.9 basis points, or 0.239% over and above the U.S. government. And that's how people, particularly in investment grade, are going to look at the value, quote unquote, value of what they're getting for taking that credit risk. The easiest way to really see this is in a chart. see across the top on the left-hand side, we've got different tabs: matrix, bond list, bond chart. We were just on the bond list. Clearly is what it is, which is just a list of bonds. The chart, we can now determine, well, what does our y-axis and x-axis look like? There are many options under the y-axis. We're going to use G-spread because we're doing an investment grade analysis, but you could do things like option-adjusted spread, yield to worst, price, really whatever you want from a valuation standpoint. But again, we use G-spread. And then on the x-axis, again, you can use many different things from the drop-down. You could use the workout date, which is going to be the worst date if the bond has got a call. I'm just going to use maturity because it's pretty simple, and these are all more or less bullet bonds. And what do we get here? We have a chart, G-spread versus maturity, of me working at Home Depot, all our bonds. Each of those bubbles represents a bond in the Home Depot stack. So if I look at the 10-year point, I can see that there are some bonds sort of around the 9-year point in a G-spread of around 60. And then I fitted a curve through those. And I did that because on the right-hand side, I have a little chart icon next to Home Depot. And the reason you're seeing the parents on the right is because if you look in the upper left, I have it grouped by CAS parent. And then if you look in the middle of the page at the top, you'll see there's a filter. The first filter is a color filter, and it's filtered by groups or colored by groups. So if it's groups, it matches what I'm grouping by, which is the parent. Therefore, every parent is a different group. Now, I've only have one up here, which is Home Depot, and that's green. But now you've got a nice, easy curve to look at of where all your debt is, priced by BVAL. You could do interesting things like now use a size filter. So you'll see here, I've got it sized by the amount outstanding, meaning the larger bubbles representing bonds are the larger deals. And if I were to put my cursor over one of those bubbles, I would get a pop-up, and it would show me a lot of information, part of which would be the size of the deal. So one deal may be $1 billion, and that would be a big bubble, and then another deal may be $300 million, and that would be a smaller bubble. So if you're in negotiations with an underwriter, or even before that, if you're just trying to figure out, we want to issue debt to do something, we want to make an acquisition, we want to buy back stock, whatever it is, what is it going to cost us to issue debt? Well, here it's pretty easy because you're looking at your secondaries, and if you were to say, where could I issue debt in 10 years. Now, bonds don't trade on regression curves, just not how that works, but it is a good reference point that, I would say that your bonds in 10 years, depending on the size of the issue, would come, in and around 70 to the low 70s versus the 10-year Treasury. And in one picture, you kind of have a decent idea of what your funding cost is going to be. And when you go to market, if the dealer is telling you that you're going to price at 100 basis points over the Treasury, may or may not be right or wrong, but at least you have a reference point to push back and say, okay, well, why do you think that? My outstanding bonds are trading in the 60s. Everything seems to be fine. Is there a reason? And they may have reasons. It may be market technicals. They may think that the market just can't handle any more retail bonds, but you've got a point of reference in those negotiations. Now, some issuers may not have a lot of outstanding debt in their own curve. And even if you do, you kind of always want to look to comparable issuers to get a sense of where you're funding versus others. So on the right-hand side, all I did was click off a couple of other issuers that I think, are comparable to my firm. So I did things like Costco, Target, and Walmart. And you'll see, again, because my grouping is parent and my color filter is groups, each of these parents has a different color. So I can see for Home Depot, there's my curve, which is green. And I can see Walmart in purple is tighter. And I can see Target is pretty much on top, except for these Target bonds out here. Now, what's going on there? I've taken my size filter and I've changed it to volume. So volume is reading. So if you remember in the beginning of the presentation, we looked at all the TRACE reported trades, and there were sizes associated with that. In the investment grade market, the reported size is limited to 5 million, meaning if there's a trade of 20 million or more, that size is reported as 5 million, and that's to protect the buyer and seller, because obviously if 20 million or 50 million of a trade is reported, that could have an influence on the price if that trade is reported as quickly as it is in the U.S. market, which is within 15 minutes. So here I've sized each bond by the average daily volume over 20 days. And what you see with those target bonds is they really don't trade. And the reason they don't trade is if I were to change my size filter back to amount outstanding, we see that those are small deals. So even those where those bonds are, according to BVAL, those aren't really representative of where Target would borrow. These larger bubbles here, the bonds that trade in Target, are more representative. So what we see here is now your own curve and also the curve of comparable issuers. So you would say, all right, as Home Depot, I think my credit is, we're doing better. I'm going to try to get a little bit closer to Walmart, and we'll see if the market can bear that. For a lot of our corporations clients, we save this view in FIW, and they just keep this up in Launchpad. So it's a relatively, is a live picture, as live as BVAL is, of where your debt is and where the debt is of your comparable issuers. Now, you can do some interesting analysis, and this typically comes up around meetings, board meetings, meetings with the treasurer, et cetera. And the question is, how have our bonds performed relative to the peer group? And we can work with you on how to do this type of analysis, and there's other ways to do similar type analysis. But what I did here is in the bond chart, I now limited to just 7 to 10 year bonds. And then I want to take a look at, of the 7 to 10 year bonds of these 4 issuers that are peers, and I'm Home Depot, I want to see how the bonds have performed over a certain time period. So what I did was I took the color filter, which is up in the middle here, and I'm able to select and say, show me how a value has changed, in this case G-spread, over a particular time period. I chose 3 months, and then color by that. So bonds that are green have outperformed. So in this case, spreads have tightened. And bonds that are red have underperformed. Doesn't actually mean that bonds widened. It just means that they underperformed the other bonds on the screen. So maybe they didn't tighten as much. But in this case, I see that Walmart has been the weakest performing bond in the peer group, the 3 1/4 of 29 all the way on the right, wider by 11 basis points over the last 3 months. And I see, my Home Depot 280s of 27 have been the best performer over that time period, and we've tightened 10 basis points. So I can talk to the board and say, look, our single bond has outperformed the others, but, that's for a defined time period. What we'd really like to do is see how has that relationship changed? How is our financing cost changed versus the peer group through time? So what I do is you'll see there's a select option in the menu, and again, we can go through these steps with you on how to do it. But I select, and that's the dotted line, all the peer bonds. So I just picked all the bonds that are not Home Depot, and I highlighted them. Then I can right-click on the Home Depot bond, and it will give me a pop-up menu. And that pop-up menu will look like this. If I put my cursor over the Home Depot security identifier at the top, I'll get another menu, and the second option says plot the performance of this bond versus the other bonds. So you'll see all the other bonds are highlighted on the screen. And what you get is a chart that looks like this. And I think this is a really powerful chart. What we're looking at in blue are the Home Depot 27s. That's the G-spread of the Home Depot 27s through time from July 23rd over the last 3 months. The white line is the simple average of the G-spread of all the bonds that I selected as the peer group, Walmart, Costco, et cetera. And the bottom is the difference. So what it shows is back in late July, these Home Depot bonds were roughly 8 basis points through the peer group and bounced around there for a while. And then getting into mid-September, that's where the Home Depot bonds really took off and started to do very well. And now they're roughly 20 or 21 basis points through. Again, I find this to be very useful. I find clients find it very useful when talking to boards about the performance of their debt. And we can work with you on how to replicate that. If you wanted to look at this in a table format, I went back to the bond list and then the sub-tab, which is the performance tab. Still having sorted out the 7 to 10 year issues of each of these issuers. And what you can do is right-click on any of the tickers, and it will give you an option to collapse all. So you see that Costco has 1 bond, Home Depot, 3 bonds, Walmart, 2 bonds, Target, 1 bond, all in that 7 to 10 year sector. The white-colored data items are the simple average of all the bonds in each of those buckets. So if I look at Home Depot, that shows me that the current G-spread is 57, and that's the simple average of the 3 bonds below it. Walmart, which I have collapsed, the simple average is 58. So what does that tell you? Okay, in the 7 to 10 year space for high-quality retailers, Costco has the best funding at 50 basis points. I'm second at 57. Walmart is 58, which is interesting, and then Target is 65. And then what you're seeing is through time, 1 day, 1 week, 1 month, 3 months, et cetera, how they've changed. So you can answer questions and say, okay, over the last 3 months, I'm Home Depot, my intermediate bonds on average are 4.7 basis points tighter. And if I look at the individual bonds, I can see that for whatever reason, the 280s of 27, which is the bond that we focused on, was actually a significant outperformer versus the other Home Depot bonds. So that would be a question that you would talk to your capital markets relationship managers and say, do you know what's going on there? Do you have any intel on why one of these intermediate bonds is performing better than the other? Because maybe it's a part of the curve where you could issue where there's a reason for demand. It could be any number of reasons. And you can also see in the 3-month space, Home Depot, tighter by 4.7 basis points, outperformed the rest of the peer groups. And Walmart was actually, as we saw on the chart, wider by 9 basis points. So those are the basics. But I think even though it's basic, it's very powerful because it gives you, clear transparency into where these bonds are valued, and as a result, where you could look to issue debt. So now on to some additional analysis. So let's start with cross currency. As foreign markets have been growing, particularly in euros, but in other currencies as well, GBP and yen, et cetera, issuers are able to find demand for their bonds. And sometimes they have the ability to issue in a foreign currency, asset swap it back to U.S. dollars or to the native currency, and get better funding. Sometimes you want to do that just to diversify your investor base. So maybe the funding is equal to, or maybe even not as good as what you would get in the U.S., but you do get overseas investors, so that if you do need to come to market in the future, you have an established base of investors across the world. So in FIW, here's an example where the source that I used is a global index, so it's a multi-currency index. Again, you could still use all outstanding, but this makes it simpler. In this case, let's be the province of Ontario as the issuer, and I've selected out all our U.S. dollar and Canadian currency bonds. And the field that you look here for an apples-to-apples comparison is asset swap. And in the settings, you can say, I want to use asset swap, but I want to asset swap everything back to something. And in this case, we'll do Canadian dollars because that's my functional currency. And on the left-hand side, you'll see the Y-axis. It's a little grainy, but it's CAD XCCY asset swap. So that's the asset swap back to Canadian dollars, 3-month CDOR plus a spread. I've grouped by currency, and I've colored by groups. So therefore, these are all my Canadian bonds, my Ontario bonds. In Canadian dollars are blue, in U.S. dollars green, all assets swapped back to Canadian dollars. And what I see, the greens, U.S. dollars, are actually, to me, as an issuer, a little bit more expensive if they're representative where I could issue in the U.S. market. I've then sized by the amount outstanding in Canadian dollars, meaning everything is on an apples-to-apples basis. So when I look at the size of the bubbles, that's the relative size in Canadian dollars of both the CAD bonds and the U.S. dollar bonds. So what does this allow you to do? Now, if you're Ontario, you've got bonds in a lot of different currencies, so you can kind of spot the opportunities. But if you're an issuer that doesn't have bonds in different currencies, you could look to a comparable issuer who does and get a sense, where could it be an opportunity? Like if you look at, let's say Walmart, just as an example, I don't know that they have foreign currency bonds, but if you see that they've got euro bonds that asset swap back to U.S. dollars significantly through the U.S. dollar bonds, and you're Home Depot, well, you might want to investigate that and talk to your underwriter and say, what's going on there? Is this an opportunity that I could take advantage of and issue bonds in euros, swap them back, and get better funding than if I were to just come to the U.S. market? We can work with you on how to set the settings so that you can do the same analysis on your own. The second advanced analysis would be similar, but instead of choosing a currency in which to issue, it would be what coupon type do I issue, fixed or floating. And what I did here was I took Goldman Sachs as the issuer, senior unsecured bonds across the curve. In FIW, you've got the ability to create something called a consolidated spread field. And you'll see that's what I have my y-axis right here, consolidated spread. And you can define what that is. And in this case, what I did was said, if it's a fixed rate bond, give me the asset swap, or you can choose the Z spread on a fixed rate bond. And I did the same for variable rate bonds. And variable rate bonds are fixed rate bonds with a tail call that step up, and those are usually used for TLAC debt issuers in the U.S. But you can just think of those as fixed rate bonds. And then for floating rate bonds, if it's a floater, give me the discount margin or the ZDM. You've got the choice. But what it does at the end of the day is it gives you more or less comparable valuations between fixed and floating. Basically, we're looking at fixed rate as though they were swapped back to floating. I've grouped by coupon type, colored by groups. So now I've got fixed rate bonds in blue, floaters in green. So everything is on an asset swap basis back to floating, let's call it here. And I can see that in general, my floaters, as Goldman Sachs, are better funding for me right now. So that if I can come to the market and replicate my secondary levels, this is telling me that I probably have a chance of getting better funding if I issue in the floater market. And again, you would talk to your underwriters and say, sort of what's going on here. And they're going to have insight into, okay, well, we've got big investors. They're putting money into floating rate. They think that the front end of the curve is going to go higher, et cetera, et cetera. But at least with FIW, you're going to have, a clear picture into the market, and you have an idea of how your debt is trading. Same thing holds here, which is if you don't have floating rate bonds, you can look to a comparable issuer that does to get a sense of what the relationship is. Doesn't mean that it's going to hold for you as an issuer, but at least it's a guide. So stepping away from the analysis tool into, monitoring the market, there are two daily news stories I want to point your attention to. You would find them in NIM3. That's our new issue platform. They're just kind of in the news section, but there's direct ways to get to them. The first is the investment grade pipeline. And the way to get to it is by typing, you'll see it in the upper right, NI for news, space, PIP-IG-US, and that's Pipeline Investment Grade US. There's also PIP-HY-US for Pipeline High Yield US, et cetera. And what that is it is a news story at the beginning of the day, written typically by a guy named Brian Smith, who was actually on our syndicate desk when I worked at Deutsche Bank, so this is what he did for a living for many years. And he's looking at what's the forward calendar in the market. Who's announced that a deal is coming? Who is road showing a deal, may or may not be followed by a deal. He'll look at M&A transactions that were financed in the bank loan market, where the ultimate goal would be to come back to the bond market and refinance those. Companies that have debt maturing, will they likely be coming to market? Companies that are serial issuers in particular months. Sometimes, like the Japanese banks might issue in Feb or March and September on a regular schedule. So all of that to give the market an idea of what's coming to market. Now, why is that important to you as an issuer? Well, if you're a retailer and you come to the screen and you see that Walmart is coming and Costco is coming and all those are coming, well, it means hurry up and get to market before they do, or pull back, because that might cause some pressure on spreads, or maybe not. Again, it's a reason to have a discussion with your capital markets relationship. The other news story, also written by Brian typically, is the end of day analysis. So if that's at the beginning of every day, what's coming. At the end of the day, we want to know, okay, the deals that came, what happened? What came? How did those deals perform? And by perform, I mean, what was the new issue concession? So that's why this news article is NI space NIC. And what you'll see here is Brian will list out the deals that came, how big was it, what was the tenors, and importantly, and also the demand. All of this comes from his and others on our news team's relationship with syndicate desks who give us this information. But this column, NIC, what does that mean? New issue concession is our team will look and say, just like we did with FIW, where were secondaries? So for Fifth Third, which is FITB, they did a 5-year. Based upon secondaries, where would we have estimated a 5-year bond would have priced, or a secondary 5-year, theoretical 5-year would be? Okay. Let's say it was going to be at 78. And then we determined that this deal priced or launched at 80. So that's saying, theoretically, this deal came with a new issue concession of 2 basis points. So the new issue cost the issuer 2 basis points more than where secondaries were trading. Why is this important to you? If you are reading these stories every day, and you see, typically there's in general recently, there's going to be some new issue concession because you're coming to market with, decent size, 300 million, 500 million, $1 billion, sometimes $5 billion, depending on who you are. The market is going to demand extra spread for that kind of size over and above a secondary trade. But you'll see new issue concessions in the couple of basis points range. If you see that on a given day, and then a week or a couple of weeks that's running at 10 or 15 basis points, that's an indication to you that there's some indigestion in the market, meaning investors are kind of holding off or putting more pressure on issuers to issue at wider levels in the primary market. If you're seeing sometimes new issue concessions are through secondaries, and that could be that there's just great demand for corporate bonds, or it could be an issuer that doesn't have a lot of debt outstanding, and therefore the market has good demand for it because they haven't been able to get it. That's all information for you to say, if I come to market, I looked at FIW, that was really cool, I had a good idea where my secondaries are, but what's it really going to cost me when I come to market? And there you need to look at the observable information of what's actually been coming to the market recently. So with all of that, that should arm you pretty heavily when you're looking at capital markets decisions, particularly in the debt markets and issuing bonds. So we will stop there, and this is a plug for next week's